Sherwin Williams. This is a materials company. They do paints, coatings, and related products. $90 billion market cap. Stocks worked for 5 years because you got 81% appreciation, got a small dividend, maybe adding 5% on top of that. So, in general, I think this one's worked for investors. Over the past year, it's gone up 17.9, pretty much doubling down on the comment I just made. These are really well-known businesses that are stable. They've been around, these guys have been around for more than 100 years. The revenue is 23 billion. Okay. PE is a little high, 29.45 in the forward PE. They're not growing very much, 0.10%. Yeah, the growth concerns me. This is going to be kind of a slow grower. And we're going to begin to deal with some things that, you know, the new president is using tariffs as pretty much a regular tool. Like he's going to be adding tariffs here, adding tariffs there. Now, Sherwin Williams, I'm sure, is importing a lot of their ingredients, materials that they need to. They might even be importing like paints and so forth that they then they get them in big containers, put them on big rail cars, and then they put them into the production lines and make paint cans and so forth. Now, if some of the tariffs affect their supply chain, that could be a real negative. If they're in a bad economy for like construction and so forth, which I don't think it's thriving. I think it's doing okay, but it's not thriving. Then those tariffs may squeeze their margins. It may not, but I see that might be a problem. Okay. Gross profit looks good. It's like 50% gross profits. I think it'll give me the percentage down here. So gross margin, 49%. Very good. For a materials company, it's excellent. So very good. Free cash flow has been a little inconsistent. We've had $1 billion, and I'm looking at the quarterly. So let me get out of the quarterly. So free cash flow, 2 billion, 2.6. Yeah, it's been a little inconsistent, like 3 billion in 2020, 1.8, 1.2, 2.6, 2 billion. Yeah, it'd be nice to see them. I think I showed a stock, I think it was MetLife. You saw that smooth upward chart. That makes me feel comfortable and confident that, hey, I could probably expect where free cash flow is going to land for 2025, 26, 27. This one here, it's a little bit too random, not very consistent. And if we chart it, it's not a smooth chart. It's kind of an ugly looking chart. All right, so that's 2 billion. So analyst, looks like 15 analysts cover the stock. Worst case scenario is it's fairly priced. Best case scenario, it's going to go up nicely. So it's discounted by 12.47 on average. If you take all their price targets and average them out, it's discounted. And they're expecting revenue growth in 2025 of almost 4%, and then almost 5%, and then 5% in 27. So the PE is going to come down a little bit. I don't like this PE. The reason for it is this is materials, and they have a higher PE than the S&P. The S&P has some pretty exciting businesses in it, so I'm not in love with that PE. I'm not in love with their cash flow. Cash flow is really low. At $2 billion, I can't get to this valuation. This is a slow growth, no growth company. If they have $2 billion in free cash flow and I multiplied it times 15, I'd get to $30 billion. That would be my rough market value of this company, which is well short of their market cap. The earnings per share might get us near this number, but it's still at a really high PE. A materials company, at best, I'd probably have a PE of 18. And that's a company that's showing like single digit growth, like 5%. Sherwin Williams does not have that much growth. It's like almost zero. So this was a solid pass for me. Um, they just don't have, they're not showing that they're going to be worth a lot more in the future. In fact, I wouldn't be surprised if this one has a lot of trouble in the next 2 years. I'm trying to look at their balance sheet, see if they have any debt. Yeah, they have about $12 billion of debt. And they have about $238 million cash. That's another factor that kind of goes against their valuation. They're not producing a ton of cash. I think based on the free cash flow, discounted free cash flow model that I would put together for these guys, I'm going to fall way short of this valuation. I'm not going to get to $90 billion of value for this company, especially when I have to deduct nearly $12 billion of cash from that value. So this one's a solid pass for me. I wouldn't be interested in analyzing the company. I wouldn't be interested in buying it. But that's just my comments. I never provide advice for you to buy, hold, or sell. I'm just sharing what I would do and how I see it. Hopefully you found the comments interesting. So that's my comment on news. Good luck with that.